Hi everyone, my name is Bagger Don at StockMarketCaddy.com, and today is July 15th, and I wanted to show you a chart on the major markets and offer a perspective that you probably have never seen before. This style of chart is what is called a three-line break. A three-line break. In the way it's constructed, this particular chart is on the S&P 500, the SPY. It is a monthly three-line break. And what I'm going to do is just to show you here, as long as the months are advancing and making higher closes, they will keep advancing in green and keeping the trend up. This is a tool to help identify the trend. And it's also a tool to determine the truth because charts don't lie. Now, when a month closes below 1 month close, a second month close, and a third month, you'll actually get a red brick. And if they keep closing lower, they will continue to stay red. The only way they can resume their trend is you need a month where you close higher than 1, 2, 3 months, and then the trend resumes. Now, this S&P line break chart monthly goes back 20 years. This is the rise up to the .com. It'll be more pronounced on the Qs, and I'll show you, but these markets all have a tendency to move together. This was that crash, the .com crash. Imagine that. That was huge, right? And then we had the housing bubble. Because what happens is when we have these crashes, and I'm going to be able to show you this, the Federal Reserve, nothing federal about it, it's a cartel. It's the titular head of all our central banks with their private partners. And they present themselves as federal, but they're not. And they cut the value of the dollar and they cut interest rates, and they tell you ostensibly it's to help with housing and help with jobs. It lines their pockets. But this was the housing boom. And then the crash. This is the all-time crash. This was going to put everybody out of work. It was going to take their homes away out in the Hamptons, that's for sure. My contention is that these were nothing more than dress rehearsals. What they needed to do, what they wanted to do, was to get the shares of America, the shares of the S&P 500, out of the hands of the common people. They tried here, didn't quite work. They really did a good job here. They scared the bejesus out of them. People were puking their shares out and puking out their retirements. And then right here, 2009, something happened. And if you were to drill down, we don't have time in this video, but I could show you right down to the day and the hour. It was March 9th of 2009, between 3:15 and 3:30 in the afternoon, and the computers got turned on. What computers? The Federal Reserve's computers. And the computers of all their friends and family and corporate buddies and all the crony capitalists. Because the Federal Reserve had made it clear what they were going to do. And they were going to steal all these shares, puke everybody out. They were going to be at ridiculously low prices. Then they were going to open up the sluice gates with QE1. That is, they were going to let their corporate cronies borrow money from the Federal Reserve at ridiculously low interest rates so that the shares that you puked out, they could buy. Now, who was going to pay for that? Well, some of the old people, the people who maybe had worked their whole lives to save money, were now going to maybe be eating dog food because their certificates of deposit weren't yielding anything. Can you imagine? So these guys got the jump on the market. This is 2009. And up we go. And we get a little pullback because there's still a little fear in the market. So what do we do here? QE2. What do we do here? This is Operation Twist. What do we do up here? QE3. Folks, we're up here. Do you know what the yield on the 10-year Treasury is? What, 2.8, something like that? Inflation is running at 3%. So you basically, if you were to put your money in a 10-year Treasury, you'd be losing money. And we got guys like Neil Kashkari at the Federal Reserve out of Minneapolis, one of the cronies, and suggesting that we need even lower interest rates. Look at this, folks. Does this look normal to you? Does this look like a normal buy and sell market, or are we just straight to the moon? I mean, we're right here, and we got people like Bob Pisanti on CNBC saying, we're breaking out, we're breaking out. That the banks are supposed to be breaking out. For the love of Pete. This is since '09. They're breaking out now? This is so straight up, I mean, it almost falls backwards. How can this be normal? It isn't normal. Let me show you something else. This is the Qs, the NASDAQ. You see the dot-com implosion. Here's the housing run. Not much in the NASDAQ. These are years, folks, years. From here to here, the 10-year span from 2000 to 2009, stocks yielded, I think it was minus 3 point something percent. Look here where the Federal Reserve did what they did. Here's the QE1 and Operation Twist, QE2. Look where we are. We're up here, folks. We're going to be breaking out. Yes, higher. Again, I mean, is this normal? How long can this continue? Let's take a look at the Dow. Well, actually, before we do that, let's go look at the IWM, the Russell 2000. This is '09. Look at this. Same thing. These all coincided with the exact same time frame. You see, the Federal Reserve, this banking cartel, they basically control the game. They control interest rates and they control the supply of money. Think about it. When you were in college playing at a poker game, if you had a guy, if one of your buddies had a mimeograph machine and he had it under the table, who do you think was going to be the last person playing the game? You or him, if he was able to print money? That's what the Federal Reserve does. Look at this. We're breaking out. Let's look at the Dow. We all know the Dow has had a really, really rough time here this year, right? I mean, I'm ready to jump out a window. I mean, it's the performance on the Dow has been that bad. Well, here it is in '09. Look at that. We're right here. We haven't even taken out the low of the previous month. This is where we are. It's normal for markets to put, I say it in normally, when you have normal in free markets, not cronyism, it's normal to see markets revert to their mean, 50%, as we go through a price discovery. But if the markets are fixed, there is no price discovery. It's straight to the moon. It's leverage, leverage, leverage before they pull the plug. Look at that. How about we look at an individual stock? How about Amazon? What does that look like? And again, these are monthly. Here is '09 right here. Here's Amazon. Look at this. That's normal. Do you know that Jeff Bezos is worth $150 billion personally? $150 billion. If you make $60,000 a year, you know what $60,000 means to Jeff Bezos? It would be comparable to $3.30 something cents. That's Amazon. How about Netflix? Everyone's laughing about Blockbuster, I guess. They just didn't come out. They came out over here when the spigots weren't turned on. Look at this. Netflix doesn't even turn a profit. Straight up. Again, if it went any straighter up, it would fall backwards. How about Apple? Same thing. Here are the machinations of the Federal Reserve. They're right down to the dates. They all coincide. How about Goog? Oops. Goog. Same thing. Here's '09. Straight up. Straight up. Now, if you think I'm kidding, let's take a look at the dollar. Now, uh-oh. Do you see this here? This was we had the crash coincides here. This is the dot-com crash. The way they got the market to go back up to 2006 and everything was to devalue your dollars. They had the mimeograph machine underneath the poker desk. You see what they've done to the value of your dollar? So, unless you own Amazon, you're working and working and working and trying to save a buck. And your dollar was worth a hell of a lot more back here in 2000 than it is today. Because that's thanks to the Federal Reserve. Thanks. They're such a nice bunch of guys. See, when they run into something they don't like, they'll just, they just crush it. You remember how there was something called Bitcoin? And Bitcoin was off and running and was presented to be a threat to the Fed. And so what did they do? They introduced the Bitcoin to the futures markets so that they could do their dirty work. Here it is. 3 months. Few months that Bitcoin was introduced to the futures. There you have it, folks. You think that's normal either? No. It is what it is, folks. It's an Alice in Wonderland world, right? They're inflating. Eventually, it will come to an end. And it will be the Federal Reserve's fault, as it was in the dot-com, as it was in 2007. In 2009, too, by the way, they didn't do it just with QE. They did it by creating things called, let's go back to it, let me just show you. They did it by creating things called exchange-traded funds back here. They shook everybody out. They created ETFs. It was much easier for them to pile money into these exchange-traded funds, and that would light up what they called the animal spirits. But nobody buys and sells individual shares yet. Why should you? You just run up. You have you thought you understood the markets over here and over here, but you have no understanding of this. Because see, they did other things too back here. They also ended something, the banks used to have something called mark to market. Can you imagine? They were expected to mark to market the assets they held. What a crazy concept that was. Because when the assets went down, the banks were insolvent. So we got to do away with that. So they did away with that. And they also put into power politically some people that were going to be very compliant. And we know who those guys were. And this is what we got. So one thing is for sure, when this does blow up, and it will be the Federal Reserve trying to let the air out of the bubble. But they won't take the blame. I can promise you that. It'll be Trump. It'll be some chump. Rhymes with. But there you have it, folks. Isn't that a wonderful perspective? It's absolutely an incredible perspective. This is the big crash. This is 1929 stuff. Oh, okay. So if you would have thought if we had learned anything from that run up, could do that, or this run up could do that. Maybe these guys think they have cornered the market, like the Hunt brothers and others, or like long-term capital made up of some ex-guys from the Federal Reserve too, the academics. Neil Kashkari thinks we should keep interest rates even lower. Free money for everybody. Good night, folks.